Happy New Year and welcome to Nasdaq Trade Talks. I'm your host, Jill Malandrino, Global Markets Reporter at Nasdaq. Helping me kick off coverage for 2020, we have Brian Joyce. He is the Managing Director on Nasdaq's Market Intelligence Desk. And Brian, stocks came in full steam ahead, risk on to kick off 2020. It really is quite incredible to see just how well the major averages have performed the last decade and going into the first day of trade today.
Absolutely. 2019 was a banner year for the U.S. equities. The S&P had a total return of 32%. The Russell 2000 small cap, the S&P mid cap, even the Dow Jones, all up around 25, 26 on a total return basis. So a truly phenomenal year. And underneath the hood, the S&P 500 technology sector up 50% total return, its best year in 10 years. On the opposite end of the spectrum, energy was really the only big laggard. It returned about 12%, which is in and of itself on an absolute basis very good, but relative to the rest of the pack, if you strip out tech and you strip out energy, the top and the bottom, the remaining 9 gig sectors had a total return on average of about 28%. So it's really
I'll take that.
good breath all around.
All right, let's pull up our chart. Speaking of total breadth of the market, this is a Russell 3000 going back a couple of years. The obvious question everyone's asking to kick off the new year is it time to take a bit of a pause here? What are the technicals indicating?
Yeah, so what I like about this, so this is the Russell 3000. It encompasses about 98% of all U.S. listings. And so it's a really good barometer of what the entire market is doing. And as you can see, the breadth, which is the lower panel here, the percentage of members making 52-week highs reached 11% in the last couple of weeks of December. And that's the highest it's been in about 18 months. So the index returned 31% total return last year in 2019, and the breadth was really good throughout. The breadth was expanding throughout. It's 11% is still well below the highs we saw in 2017 and even in early 2018. So that number could certainly get a lot higher. But it's good to see broad participation and not just say a market rally driven by a few of the big heavyweight names. All
right, let's move on to China. This is our next chart here. Some good news helping to boost stocks this morning that China is going to look to add another QE program, if you will, injecting some more cash into that system to spur some more lending.
Yeah, absolutely. So just to take a step back, the U.S. markets did very well. They outperformed the global markets, but many individual companies, their main exchanges, did extremely well. Russia was up 40%, Brazil up 34%, Italy, Ireland up 32, 34%, Colombia, Switzerland, Turkey, all of these countries, their main indices were up more than 30% total return in 2019. China was up about 25%, still a very good number. And as you can see right now, it did finish off last year below its 2019 highs, but in the final week and today, it's now breaking out above a key resistance level at that 30-50 level. So, and that consolidation has been taking place for about 6 months now. So breaking out from a 6-month range, that's nice to see. Usually we'll see some strong momentum behind that. So that should bode well for the future.
All right. Now, earlier you had mentioned technology stocks. Everyone's looking to get a piece of that. Now, the China Internet ETF. This is really interesting. This is our next chart we're going to take a look at here. And you're seeing a lot of institutional participation with this particular ETF.
Yeah, so when China does well, this ETF tends to do well also. It's a focus on internet stocks in China. It trades over 1 to 1.5 million shares a day on average, so it's an institution. It's an institutional instrument as well. And as you can see right now, this week it's breaking out above that 49, 49.5 resistance level. Today alone, it's up about 4.5% on that good news coming out of China. And it's a pretty big base between $37, $38 on the support and 49 on the upside. That's a pretty large base, about 30% width right there. It looks like a large double bottom pattern is taking place. So there's your risk level at the 49, 49.5 range. If you go long here, you know where your exit point is and how to measure your risk and your position size accordingly. But if China is going to continue to the upside, I would look to this instrument as one of those leverage plays.
All right, now if for some reason things do not remain the same and you start to see a sell-off here, 30 to 38 levels, where you'd be looking to make a new entry?
Well, right now we're up to 51.40,
right.
So 38 is the bottom we've seen in the last 12 months. If I was buying this based on purely technicals, I want to see this breakout level hold. It would not surprise me if we've seen a pullback in the near to intermediate term that would retest the 49, 49.5 breakout level. And so I would adjust or set my risk or stop exit around there, maybe 1 to 2% below that level. Based on the volatility, this probably is a lot more volatile than your typical instrument, so maybe you want to have a little bit of a looser risk level, which means then you want to just adjust that position size a little bit lower. If it gets back all the way down towards that 38 level, hopefully you've long been you'll have long exited the position.
And might be looking to get back in if you can get down to 38. Well, thank you so much for kicking off coverage with us for 2020. And thank you for joining me on Trade Talks. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.